Hi, I'm Kara Murphy, and this is Money with Murphy. This quarter's earnings results are some of the clearest signs yet that artificial intelligence is rippling through the economy. And it's not just technology, industrials are increasingly part of the story too. So let's start with the big picture. And as earnings season wraps up, second quarter results have been among the strongest in recent years. More than 90% of S&P 500 companies have reported, with earnings up nearly 12% year over year, well above the 5% expected. While just shy of the 5-year average, growth is still almost 3 percentage points higher than the 10-year trend. Revenues have been strong too. 81% of companies beat those estimates, the best showing since mid-2022. Revenue growth of more than 6% is the fastest since late 2022. Profit margins also improved, climbing to nearly 13% above the 5-year average. Now, part of this strength reflects lowered expectations heading into the quarter because of tariff concerns. But even with that lower bar, a combination of earnings growth and rising margins shows that companies are navigating those headwinds surprisingly well. The real story, though, is who's driving that growth. No surprise, it's technology. 92% of tech companies beat expectations, accounting for almost 60% of the total earnings growth this year. Tech now makes up 1/3 of all S&P 500 earnings, triple its share 2 decades ago. Much of this momentum comes from the AI build-out, with cloud providers, chip makers, hyperscalers like Google, Meta, Microsoft, all investing heavily in the infrastructure that's powering this shift. But AI's influence is spreading beyond that to industrials. 81% of companies beat expectations, more reporting backlogs and rising demand. Surveys such as the Chicago PMI confirm that trend, with June showing one of the 9 largest increases in new orders on record. It's also worth noting that the strongest results remain concentrated in the biggest companies. The top 100 stocks posted 14% earnings growth and returns on equity in the mid-20s. Meanwhile, the bottom 400 saw just 3.5% earnings growth and 17% returns. That gap helps explain the lofty valuations for the largest names. Still, small cap showed progress too. 68% beat estimates, their best in over 2 years. Now, looking ahead, guidance is encouraging. Over half of companies in the S&P have issued forecasts for 2025, and more than 60% were positive. A majority have raised expectations for the rest of this year. So what's the takeaway? Results broadly exceeded expectations despite tariff concerns, and AI is reshaping not just technology, but other areas of the economy too, such as industrials. So until next time, invest wisely and live richly.